Welcome to the Connection Collaborator YouTube channel, which is the face of the Coach Up podcast. I'm Kanisha Hart, and I'm very excited to be here with Justin Maxwell to talk about taxes, but from a very high level that most people don't know about, and strategies and components that are very important as you get to that above that six figure mark, which is where all of you guys, as my audience, are working to get to. So, Justin, thank you for being here today. Please introduce yourself, tell everybody who you are and what you do.
Thank you, Kanisha. I'm really grateful for the opportunity to speak to your audience, and I'm grateful that you have been so kind to me and allowing me to come. So I am a professional that is, it's hard for me to find, so let me describe it to your audience. But I live in Salt Lake City, Utah. I've lived in a few places across the country, but Salt Lake City is where my family and I currently call home. I am a partner in a firm called Big Life Financial. And our firm specializes in helping create what's called a fractional family office, which is the idea behind a family office for your audience is family offices are usually reserved for individuals in our country that have a net worth of 100 million, 200 million or above. So they're really exclusive. They're very expensive to have. But we liked that model. We consider it the gold standard of advising. And the reason we liked it is it gets all the financial professionals in the same room collaborating and talking. So everyone's rowing in the same direction. You don't have the financial advisor saying this and the accountant saying this, where they're going in opposite directions, or maybe they're slightly off of each other, because it creates inefficiency. It creates doubt in people's mind. It creates confusion. And then people don't take action, or they don't reach their highest level. So what we built was that same type of collaboration amongst financial professionals, but affordable to the business owners that aren't having $100 million worth. So we have accounting, wealth management, protection, estate planning, business exit planning, all under one roof. I am not an accountant, but because of my knowledge in the company and who I am in the company, which is the intertwining piece between all of these threads, the person that gets all these people to collaborate, I have a very high understanding of the way that we tax plan, the way that business owners should be thinking around taxes. And so my advice today, the advice that I'm giving is not specific tax advice to you, but is to get you thinking differently about taxes so that you can start doing things differently and start seeing more tax dollars stay with you, which is the most important part. So I want to get you thinking differently around this because it can be eye-opening and it can make a massive difference, not only today, but over the course of your business career and over the course of your life.
You bring up a name, Justin, that I don't think a lot of people are even aware of, right? Before meeting you, I think I had heard the term family office, maybe in a one-off, maybe I'm listening to something and it's the wealthier set who's talking about it. So, which is one of the reasons why I wanted you to come on and break down, okay, what exactly is that? And I want to get to where you did a great comparison when we talked about like normal tax preparer versus the team, as you just mentioned. But first, before we get there, can you break down who would be on this team? And maybe not, we'll maybe go into who would be on the team, like what they do in a little bit, but people hear team. I know I would hear team and I think my CPA should be able to handle, or my accountant, or I might have a CPA and a bookkeeper at the most. But you mentioned team. What are the players that could be on this financial team?
Yeah, the first challenge I'm going to challenge you is to stop thinking of accounting or taxes and wealth manager and investment advisor or my insurance people and anyone that helps me grow my business or scale my business. Stop viewing them as all separate industries. You need to view them all in the same room. They're all the same thing. They're all trying to accomplish the same goal. They just have different jobs and roles within it. So the easiest way I want you to view this is there's two layers to this team. Team number one is my inner circle wealth team. That's going to include probably, it doesn't have to be your accountant, but someone from the tax department, which I'll describe in just a second. So that could be your accountant. It could be your tax strategist. You need to have someone that is in the wealth management realm that handles investments or cash flow or helps you invest outside of your business or helps you store money somewhere. You need to have someone that's focused on helping you keep your money. So that could be an estate attorney, that could be a insurance professional, that could be someone we categorize as a legacy person. someone that's focused not necessarily on the legal documentation, because that's important, but what's more important for people to know is, how do I make what I'm creating last? Because most people that pass money, it disappears, like it's gone. It's spent usually for most families 7 years after you pass away. How do you prevent that from happening? The legacy person can do that. And then the last person that I would include in your inner circle, probably not for your audience yet, but something to look forward to, is this is someone that's going to help you scale your business. They're going to help you see your business as an asset. Most business owners view their businesses as cash flowing assets. It pays me income, it pays my job, it does a great job at that. I have a great life, I'm living fabulously, but they're not making it something that can be sold in the future, something that has a high probability that someone can purchase it from them. So having that person integrated in your team will help ensure that that actually happens, because if you do it right, businesses, like most business owners, have somewhere between 70 to 80% of their wealth in their business. But if they haven't made it desirable to someone, they're never going to realize it. And so then it just gets left on the table. So that person will help you realize that, so that it's not left on the table. Those four people are your inner circle. They're collaborating, they're coordinating, they're talking about where should we put money, how should we handle tax strategy, and how do we protect ourselves from downfall. Underneath all of those people represent departments of the tax team. Has a group of people, which we're going to dive in really deeply today because that's the focus of our conversation, but so does the wealth manager. It's not just relying upon one person to be the expert of everything, but they have groups of people. It doesn't have to be hired within them, but they have people that they can communicate and collaborate with that will help coordinate your plan together. And so there's layers of people under each of those people that make sure that they're doing their best job, that keep them accountable, that make sure that they have all the options on the table, so that you, as the business owner, have the highest probability of reaching your maximum potential wealth. And the way I like to view wealth, I like to view wealth and impact simultaneously. So if I'm increasing my wealth, I have the opportunity to also increase my impact, which is a lot more fulfilling and will allow you to actually not feel guilty about growing your wealth or getting bigger, because you're actually helping more people and you're serving more people, because you're focused on impact, not wealth. But when you start to intertwine them, they can rise together.
Yeah.
So that's the way I would describe the team. Was that helpful? Do you have any follow-up questions that I can clarify, just as a general overview?
Yeah, no, that's good. Let's dive next into the specificity of the tax portion, because that's what we're talking about. But before we get there, you said something that I really loved, about the more money you make, the more impacts you can make. And I remember going to breakfast, Justin, in Charleston, South Carolina. And Charleston is a city that is huge on relationships and organizations and giving back to the community. I'm sure there are lots of cities that are, but that is a thing there. And at this breakfast, there's a lot of business, a lot of money in the room, a lot of high profile businesses, business executives. And the speaker was an executive at Boeing, because Boeing has a big presence in Charleston. And as she spoke, she said her mother told her when she was young, I know you want to help people, but do not go into the nonprofit world. And I'm not saying don't go into the nonprofit world for people listening, but she said, her mother said, get a job or find income that is going to put you at a high level, because you can do more good with an extremely high income for those who are in the nonprofit world to help to support them than you can being an executive director at a nonprofit. Right? Like, you're going to impact those people from that, but you'll probably be making $150,000 a year, maybe a little more, but you only have a small impact. But if you're making 800,000 and $2.5 million a year, you can pay somebody's salary for the nonprofit, right? And the impact is so much greater. And so I love that you brought that up, because sometimes people have that wrong mindset about, oh, I don't want to make too much, I want to spread it out. No, the more you make, the more you can help. And I think that's important.
Yeah, one of the things we can just talk about right now is a member of the tax team who is also a member of that protection team. Is a lot of people think they're out of reach of a private family foundation, but private family foundations, about 60 to 70% of them nationwide have assets under $1 million. But it can be a great way for you to do exactly what you said. So instead of just giving away money one time and having it never be able to be perpetuated, you can donate to your private family foundation. It can be grown within the private family foundation. And then whatever amount you want to give on an annual basis, let's just say it's $10,000 to a charity of your choice, every year is going to be spitting off $10,000. And you can perpetuate your giving over and over again. And then every dollar you add in addition to that will just increase that giving amount. So, but the cool thing is you can tie it into tax planning, you can tie it into your legacy, you can tie it into the way that you're giving, but it's a different mindset. And so everything we're talking about today is choosing to think differently than what the average American or the average middle class person does. Because if you're aspiring to grow a business and help people, you should have a vision of something far bigger than you can even grasp onto, because that means you have helped so many more people. And just think about the perpetual cycle of giving. If you set up these structures, it gets really exciting for me. Like, it's generational. It's not just you. It's going to last for generations, which is really exciting because a lot of people are down, they're depressed, they're victims, they're not excited about life. This is exciting to me. And so I think this can give you the permission to get excited too.
For sure. I have never heard of that term. And it puts me in the mindset of my mother is a huge education advocate, and she has started two scholarships for our family that, to your point, every single year is helping an individual be able to afford their schooling. And that's generational legacy for our family, and it's generational help for that individual, right? However they move on, go from there. And then she started another, so there's three in total, but she has that mindset, just at a different level with the scholarship. And what you're talking about with the private family foundation is very similar. So I love that you're talking about changing the mindset. And so let's dive into the tax portion team, and help. Can you help people understand like how they should be thinking about it, the differences in what you do, and once you get to that six figures and past versus where a lot of business owners may be thinking now with their releasing.
Yeah, so let me paint a picture of where people probably can recognize and see, and then paint the picture of how that has some limitations. Then we can shift that over to what should we be looking for differently, because we're not this. This isn't us anymore. So first, you need to understand that 95% of Americans don't need tax strategies. Most of them are W-2 employees. They don't make enough money. It doesn't even make sense for them to do anything tax related. So if 95% of the population falls in that category, how many accountants do you believe are also going to fall in that category, because that's their clientele? So you have to realize that most accountants aren't built to service business owners who are on an accelerated path of wealth or money increase. So you have to just realize that the people you have hired now probably aren't built to serve you once you rise anywhere above 100 grand or 150,000. Maybe a base level, they know it because they're not stupid. They went to school, they have the tools. It's just that most of clients don't need that. So they don't stay up to date on it. They don't know all the details of it. They don't have to stay in compliance with it. So just realize, number one, that that's the case. But with that being the case, still, here's the picture of how most people handle their taxes. So usually business owners will hire one accountant because that's what they're told. Hire a great accountant. That's how you save taxes. That's what people are told when they start businesses. Get a good accountant on your team. So they hire someone. But usually now that's all they hire. So it's just one person. That one person is going to be extremely reactive. What I say by reactive is they're not going to plan with you. They're going to ask for your data. So they're going to say, give me your numbers. Sometimes it's November or December of the current year, but often it doesn't occur until January, February of the following year. And then they'll tell you, this is how much you owe in taxes. So you had a better year. We already paid our quarterlies, but you owe an extra 10 grand because you did better than we thought. That system of reactivity is never going to work. Like, you're never going to find tax savings doing it that way. The third thing that in this current framework that we're painting a picture for is one accountant reactive, is that most of them, if they do offer any advice, let's say you've given them your data in December and they say, oh, you owe an extra 10 grand, you're going to say, well, that's a lot of money. Is there anything I can do about that? And their response is going to be, well, is there a piece of equipment you can purchase? Is there a course that you can buy? Can you go buy a truck to get under the 6 pound limit? They're going to go have you buy stuff. which could be good, but sometimes you're buying stuff when you don't need the stuff. So you're not actually tax planning, you're just spending money when you could have just paid the taxes and invested or grown or put back in the business what was left over. So it's the wrong mindset. The fourth thing that comes from the one accountant reactive is that most of them, if they do offer any tax strategy, the tax strategy is the qualified plan. Like that's when they say I tax plan, all they're having you do is put money into a qualified plan. So that's like a 401k, that's a SEP, that's a defined benefit plan. So yes, it saved you taxes today, but oftentimes they neglect to tell you that when you start pulling the money out, that's when you start paying the taxes. So you really just kicked the can down the road. And if you really are building wealth right, you should have more income in the future, not less. Because the idea is, well, if I put money in here at this tax bracket and I pull it out here at a lower tax bracket, I've saved taxes, which is true. But that means you're living on less money. With inflation, with the mindset we're creating, that's really not the mentality you should be having around saving taxes. So that doesn't work. But that's usually when they say I'm a tax planner, the qualified plan is what they're utilizing. That's the framework or the reality of most business owners across the country, even really successful business owners. Like we've worked with business owners that have $10 million of revenue. They personally are making $800,000, $1 million a year, and they're still utilizing that framework. The problem with that framework, it has a ceiling because their biggest thing is the qualified plan, and you can only put so much into a qualified plan. So we have to shift away from that. But before I do, is there any clarification points that you can see, Kenesha, that I need to make on that picture that I've painted for
I
them?
think you made a very clear, I think one takeaway that I want you guys listening to hear is, Justin, as you said, that 95% of people are using and won't need what you're about to describe, right? And what your office does and what you do. But as you grow, if you are growing your business past that $150,000 mark and up, know that your accountant and tax person are probably also in that 95%, and they're just not the right fit. And so I just wanted to reiterate that because it's such a good point that we often want to stay and do business with people we're comfortable with and that we've associated with, and they've gotten us this far and we haven't been audited and we haven't felt like we've had to pay a whole lot of taxes just because the mindset shift hasn't happened, or they don't even know, they're not exposed, which is why I'm so glad you're here. But know that as you grow, your network has to grow as well.
Yes,
So,
I really appreciate that. And
yeah,
that framework is great for most Americans. Like that 95% framework will handle most Americans. It's going to be great. There's nothing wrong with it. It's just that you're not them anymore, or you're not going to be them anymore. So you have to adjust with them. So the way that we make that adjustment is we're going to shift from one accountant to a tax team. Now, the team really is going to be centered on two people, but I'll describe some people that you should consider as you go about doing this process as you grow, so that you can have these people in mind and reach out to your accountant and say, do you have these folks? Is this someone you have in your network that can help me as I grow? Because if they don't, you either have to go find them or you have to find an accountant that does have them. So the two primary people you need to have at the top of your tax team are the compliance officer, which is who the accountant is. That's who usually this person over here in the other framework is they're just compliance. They're really great at filing the taxes. They're really great at following the law, and they're really great at telling you how much you owe in taxes. Very needed member of the team. You're not kicking them out. You're not dumping. They're there. The other person, though, is a tax strategist. This is the person that thinks differently. This is a person that's not focused on compliance. They're focused on bringing all the strategies that they can find to the compliance officer and having conversations and debate about, is this a good fit for our client? Is this real? Is this fake? Can we get down to the nitty gritty? There's lots of stuff that is low hanging fruit that this person can bring. Things like the Augusta rule, where you rent out your house, or paying your kids on payroll. All those types of things are things that they're bringing in, a whole bunch more. Okay. The tax strategist is likely the person who's going to assemble all of the team members that I'm about to describe to you, because they're the ones going and finding all of these ideas and making sure that they happen. It's very, very rare that you can have these two people be the same person. I have associated with lots and lots of accountants. They're two different ways of thinking, and it's very rare. It can happen. Like I've met some that this is great. I'm in complete transparency. Our accountant is someone that can do both in our in-house, but that's because we found him and we brought him in and he's really great. But most can't. So just know that that's probably going to have to be two people, but it could be one. The way that you're going to tell if it's two people is by they're proactive with you. So they're proactively planning beforehand. So they're meeting with you in January, in the second quarter, and third quarter, and fourth quarter. If it's one person, if they're proactively planning with you, you're going to know that that's a person that I can start to rely on as a strategist. Now, you still need to hold them accountable, still ask questions about these team members. I'm about to tell you about who should be considered around as you grow and what levels you should be at. But that's how you can kind of tell. If they aren't a strategist, they're going to be reactive. If they're more on the strategist side, they're going to be proactive, because the only way to access strategies is to be proactive. You can't be reactive. You have to do them proactively. So that's how you can start to sense it. Does that make sense before I move on to the team members?
Yeah, that's perfect.
Okay. So now who is under them? Who is helping devise this and create this plan? If you're at $150,000 of income, you only need those two. Those are the only two. Once you rise in the 200, 250 range, you need to add just one other person, and that would be just a registered investment advisor. The registered investment advisor is going to bring to the table assets that can be purchased that will also save you taxes. They're going to help assess your personal situation. They're going to make sure that it's actually right for you, that that's the right investment. But there are things that can be purchased that will save you taxes simultaneously. A lot of people are very, very familiar with real estate. Like, if I buy real estate, I can depreciate it and I can offset my passive income. That's a tax smart investment. But the only way to access tax smart investments is to have a registered investment advisor or someone that specializes in the alternative asset space. So most investment advisors are really great at the public markets, the stock market, the bond market. Those investments don't save you taxes. You can't invest into anything. Like, I could technically invest into a REIT, for example, which is a real estate fund inside of the stock market. I don't get any tax benefits for it. But if I purchase a physical property, I do. But the only way to do due diligence on a physical property that comes from a registered investment advisor is they've done the due diligence to make sure that's a good investment for you or something that should be considered. If you don't have that person on your team, it's never going to be brought to you and you're never going to take advantage of it. So you don't have to have them as your advisor, but at least they could be your advisor, but it has to be a member of the tax strategist or accountant team that can bring that person in and say, I have a client that I think fits this mentality of, let's put some money here that will help us save some taxes on stuff, that they can then assess with you to make sure it happens. So it's almost like you're adding, if you have another financial advisor, you're going to add someone that specializes in the alternative investment that's going to be tied to your tax team. There's other asset classes in the energy sector, there's farms, there's agriculture that can be brought, that can be purchased, that can provide tax benefits simultaneously. But if you don't have that person on your team, you're never going to know they exist, and you're never going to even have the opportunity to take advantage of them. So that's the first team member. The second one is, as you rise into 300, probably into up to the $600,000 of income, you're going to want to start to consider adding some tax attorneys to your team. The tax attorneys, don't get confused by this, because tax attorneys charge a lot of money to do what an accountant does. So the compliance officer. But I'm just to be frank, if you go out and do this on your own, a lot of them are going to behave just like that middle class accountant. They're not going to plan proactively with you. They're just using their title of tax attorney to charge you more, but they're not bringing more value. So when I'm saying tax attorney here, it's not you finding them, it's your tax team finding them, but you can ask your tax team about them. But it's going to be access to potentially investment opportunities where we can do some donations or some entity structuring things where money is going to flow between entities so that we can offset income between entity movement. But tax attorneys, there's some that specialize just in those specific areas. And so you bring them in to help you construct the case and get access to them. So they're also really handy if things get, because as a reality of the situation, if you're making more income, your chance of audit goes way up. It doesn't matter if you're being as basic and paying as much in taxes way over than you should. If you make more income, your chance of audit goes up. Having tax attorneys on your team helps because their knowledge of how to defend those is higher than an accountant typically. and they'll be able to defend it with more accuracy and help you get it done so that it doesn't go in a negative way for you. So that's a value add there. Any questions so far? Because there's more here that I want to get to, but I just want to take a break and make sure it's coming across clear to you, Kanisha.
I do want to ask this about as you move up the range of income and hearing this, my question was, does this apply to W-2 individuals who may be earning this, or is this more appropriated toward business owners?
So W-2 individuals can do things specifically in that tax smart investment space where I'm investing into assets and saving taxes. That's available for W-2 employees. There are some donation things that can be done for W-2 employees, but you'll have the biggest effect from a business owner. The list is a lot bigger of strategies that can be implemented as we put all these pieces together if you're a business owner.
Makes sense. And then my other thing was I wanted to reiterate what you said about you've said it a couple of times, your accountant team, your tax strategist and accountant team, they should have these team members as part of their team. So when you're interviewing, as you should interview multiple accountants, multiple CPAs to find the right fit for you, this is one of the questions to ask them. And so I'm curious, Justin, I'm really putting you on the spot here. Is there maybe a list of questions or recommended questions that you and your company provide for individuals who may be interviewing? So they're not necessarily working with you, but this way they have something to say, these are some of the questions that we should be asking as we're looking to source individuals such as you're talking about.
Yeah, so I have a form. You can let me know if this is if I can cut it down, but let me know if you think this would be valuable. I have a form to ask questions, but it's more on the whole team, the wealth team, the inner circle wealth team. How do you find all those people? What questions can you ask? I do have a list of all the questions, or just questions you can ask. It's not all of them, because you'll probably think of more as you go through the list, like, oh, this sparked something, I'll write it down and ask them this. But then it also has a list of all the professionals that you should consider amongst every team, not just so you can find them and know that they're there. And just, again, interviewing the CPA, do you have access to someone like this? Because I want to really make sure that as I grow, because right now I probably don't need this, but 2 years from now, I anticipate to be at a level where I might need this person. Is this someone that's in your network? I can provide that list, but I also could make it tax specific as well. It'll just take me a little more time. So if you think the whole list of all the professionals is valuable, I'm happy to share that. But if you want to be tax specific, I can also do that. But the tax specific would just be a subset of the whole thing. So it's already there. That
whole thing would be amazing. Thank you.
Okay. Yeah. So I'll provide that to you and you can share it with anyone that desires it. So the next step down, it's not next step down, because right at this level, we've been describing 200,000 to 400,000 or even up to 600,000. Another person should be considered. And it really is dependent. I call these people tax specialists. So they do one specific thing inside the tax code. I'm going to give some very specific examples, but there's going to be more than what I'm describing, because just it could be a long conversation if we kept saying every single one. But I just want to give some examples so you know exactly what I'm talking about. So the research and development tax credit is a tax credit that's been in the United States tax code since 2015, but it's been used in the United States since 1981. For the longest of time, even to today, really, really hyper-focused on America's largest companies. Like, we're talking the billion-dollar plus public companies that everyone could name off the top of their head, the Amazons, the Microsoft, heavily used by them. But small business owners, for the most part, really have been left off the table for the R&D credit. And it's not really because they don't qualify. It's mainly because there hasn't been a lot of specialists that service small business owners. So you'd go to a firm that does the R&D credit, they're a specialist firm. They have a criteria of you have to make $50 million or more. Anyone below that, we're saying we don't qualify, it doesn't work. But it's not because you don't meet the criteria of the code. It's just because no one's there to service you. So there are people in this country who specialize in the R&D credit. And it can be a good win. Credits are a dollar for dollar write-off of tax dollars. So if I owe $1 in taxes, it will eliminate $1 in taxes. So the business has to be something that has a project in one of these 4 sciences. That has to be in biology, computer science, physical science, or engineering. It doesn't have to be the primary focus of the company, but they have to have the project that they're working on in their business, that they're trying to create a new product, a new system, a new protocol. or improve a system or protocol, that project has to be centered on one of those four sciences. If it is, it's likely that there's a credit generated. A lot of small business owners, this is on the business side, not the individual income side. But if the revenue rises into the $400,000 to $500,000 of revenue range, it can make sense to start looking at the R&D credit. It's not going to be this huge, massive win for you, but it could be $5,000 off your taxes because you got the R&D credit. And then you pair that with all the other planning that's happening, and all of a sudden you're paying a heck of a lot less than you were. So it's just another piece. But right now in the United States, you have to have an R&D specialist firm. If you want to do it at the most accuracy, do it for you. And a lot of accountants just are going to say no because they don't even realize the mechanics behind it. So that's what I mean by specialist, is they should have a specialist on a team that can access that for the clients that need it. It's not going to be everyone, but for the clients that need it, let's do a review. Let's find out if it's there and let's make it happen. Another one that's really specific is cost segregation. And that's for people that are owning their own buildings or starting to get into the real estate space where they're owning single family homes or apartment complexes or hotels, just real estate in general. You can accelerate how much depreciation you get by cost segregating the property. If you want to do most accuracy, it's best to have a specialty firm do it for you. They can usually do it cheaper, and they're going to have a great engineer that already is on staff that can value everything. So that's another one that's a specialty person that can save you taxes if you have them on your team. So that's also on that list. Any questions on the specialty people, or I can give more, but those are the two examples I think would be most applicable to most people.
I am just unnerved and blown away because, as you said, I've never even heard of these. And the research and development portion, of course, we hear with large organizations, but the fact that that can be applicable to a small business, as long as it falls in one of the four sciences, is amazing. And the dollar for dollar tax credit, that's insane. So no, just very excited about what the options are. So no, please continue.
Excellent. So now we're going to start moving into levels of wealth that's considered the top 1% in America. Once you rise over 600,000, you're in the highest of tax brackets, even if you're married. And so you're paying 37% federally. If you're in high state tax brackets, you're looking at 40 to 45% of your income being taxed. And now we're looking at other strategies. So just one more layer deep is we're going to be looking at what we like to call just a tax smart insurance advisor. So this is where we start looking at, prior to this, we've always had to pay our insurance premiums commercially. So we have to find an insurance company, we pay a premium. Just as a simple example, so everyone's clear what I mean by premium and payment, because insurance is a messy world and sometimes people don't quite get it. If I own a car and I have car insurance and I pay a premium to my insurance company for that car, I am never getting that dollar back unless I get in an accident to replace the car, but I'm never getting it back. So a tax smart insurance advisor, when we start to get to these upper levels of top 1% wealth and we get rise over the millions, we start looking at how can we as a business start to shift, or even personally shift some of our, a portion, a very specific portion of our commercial insurance to a private insurance company that we own. So we're paying premium to a company that's ours. And so if we never use those premium dollars, we never have to make a claim, they're not going away from us. They're growing, they're getting bigger, and they're going to be utilized for future wealth development. Like they're a part of our ecosystem. So a tax smart insurance advisor is going to help you access those and assess whether it's a good idea. Those are expensive to get into, but the way I would view it, if you're getting into those, and if you are hearing me talking about this, you're going to know exactly what I'm talking about. You want to be about 15 to 20% ahead on every dollar that you run through that insurance company. So if I had not done it, I would be 15% behind on every dollar I have through there. That's the mentality that you like to see around that. And then there's also some things on the life insurance side that you can do when it gets to private placement life insurance and some really unique things there. But this is rising into the $1 million range. But knowing that these things exist will keep you steadily always keeping your tax dollars, because we meet a lot of people that are 45, 50, They've been making extraordinary money through their business for the last 10 years, last 7 years, but they haven't implemented any of this. So let me give an example just to highlight how dangerous this is. So we met a doctor, Dr. Marshall was his name. We did a review for him. We found that he had been unnecessarily paying over $100,000 for the last 3 years in taxes, but he'd made that income for the last 10. So we surmised that it had been for the last 10 years. That's $1 million that's at the IRS and not coming back that should have been with him. But it's not, that's only like $1 million is like horrible. Like that hurts your heart to hear that $1 million left. But it's not just the million that left, it's what the million could have turned into. And he's only 45, so he has a 20-year runway before he probably starts using assets, maybe a 30-year runway. Like that's multiple million. Like it's if you like, I can't say in dollar or percentages, but it's going to be close to $10 million lost just from unnecessarily paying taxes. That's the difference between financial independence and not. That's the difference between a legacy and not. That's the difference between replicating your income when you have to step away from work and not. Like that changes people's life. So that's why you can't view tax planning in its own silo. It is wealth planning. It's not just tax planning. We have to bring it into this is helping me create wealth, not just save me taxes, because the save taxes should be driven into wealth creation. That's the way I like to view it. And I think that helps people think differently around it, because that's too much money. That's a painful amount of money, because most people struggle to get to even $1 million, and he's lost $1 million just in taxes.
Yeah, that gives a very tangible visual of, as you said, not just unnecessary taxes being paid, but the amount of money that could have been made with that, the legacies that could have been insured with that, the people that could have been helped with that.
And even if you're not at that level, like let's just say you never reach that level, you do great, you get to $100,000 level, you make it to the $200,000 level, which is top 5% income, you're doing extraordinary. The proportionate percentage savings for you are going to be just as impactful to your wealth world as it is to his. He just happens to make more money. So don't scoff at, well, it's only $20,000 that I'm saving and not $100,000. That's $20,000 that can turn into something. And it likely over your course of your career would be millions of dollars in saved taxes if you're really diligent about it. So don't scoff that that I'm too small for this, or this is something I'll do when I get to that level. Do it now so you can transform your wealth world. Don't compare it your wealth world and your legacy and your generational wealth. That's the way you need to view it. Don't compare it to other people, because someone's always going to be bigger.
That leads me to a great question as we wrap up here, Justin. I'm sure a lot of those who are listening and will listen will think, I already pay my accountant enough money. And it's a mindset shift. I get it. But I can hear the thought process of, can I even afford the additional team members that come along with this? My question would be, can you not afford to have them? But what would you say to that?
Yeah, it's honestly, that's the biggest hang up. We're not even that expensive in the grand scheme of things. If you look at our costs compared to other people, but we still get that thought is that's more than I'm currently paying. So the way I want you to view this is, I'm currently paying my accountant, let's just say it's $2,000 a year to file my taxes and pay them. That's the initial fee, but the rest of the fee is going to be everything above and beyond that you paid. So if you overpay your taxes by 10 grand, your true fee is $12,000. So are you okay paying 12,000, or are you okay paying 3,600 or 6,000, which is where we have two levels of service depending on where people are at? Because that's the difference between what you're currently paying. And that's the true cost. You got to pay, what is my cost and how much am I overpaying? And if you aren't doing any of the strategies or proactively planning, you are overpaying your taxes. If you just think your guy's the best and he does all the magic, they're not. They're not doing it. You're overpaying. You have to proactively plan, and you have to have a team. That's how you save taxes. There's no magic to it. There's no secrecy to it. There's experts in this world that are really great at the tax world, and you have to bring them in. And you technically our experts, the people that we have collaborated with and brought in to help us build our tax plans, like your accountant probably, if they're doing this right, would be bringing the same person in. So it's not like they're exclusive to what we're doing. Like we're not some secret sauce here. Have a team and proactively plan, and you will save taxes. And that's how you do it. Everyone wants it to be this strategy is the one solution, or this is the one magic pill. But it really is the structure and consistency of year after year doing the same thing over and over again with a team and with being proactive.
Justin, how can people follow up, ask you questions, get more information?
Yeah, the easiest way well, number one, I think sometimes people get a little bit hesitant in just reaching out. So for those people that are hesitant, they might want to learn a little bit more about me. I have a YouTube channel that produces content. It's not just taxes, but it's all things wealth, business exits, and wealth management and taxes. Like it's all integrated in there. But it's at Max Wealth Preserve is where you can find that, and I can get you the link to that. And you can just follow along with the content. And if you feel like in the future you're like, yeah, I'd like to reach out at that point, you're more than welcome to. I'm also constantly posting on LinkedIn, so you can find again me there, Justin Maxwell. You can look it up again. It's Max Wealth Preserve is the tagline there. And then for those that are like, you know what, I just would like to have a consultation. We offer complimentary consultations based off of where people are at. We'll give you a review of here's how you currently file your taxes. Here's how we would have filed them. What's the difference between the two? Can we bring value to you? If it makes sense, like just stick with your person right now and then make sure they add these people in. It's never like a hard sell. We just want to bring value to you so you can have a picture of where you're at. Someone's actually assessing and showing you, am I overpaying or not? And then you can make some changes off of that. But the easiest way to access me that way is to go to biglifefinancial.com/TRP, and you'll get on my calendar, and then we can have a conversation and we can do that assessment. And it's completely complimentary. There's going to be no obligation. It's just really just a foundational way for us to continue to push this narrative that business owners need to start tax planning differently. And so it'll help us accomplish that to get in front of more people.
Long way. Justin, I can't say thank you enough because this has been truly enlightening today. And I know has expanded individuals' perspective and understanding. Maybe I won't say understanding because there's a lot to wrap around, but the exposure so that now you guys know these things even exist and you can contact Justin or you can do more research, visit his YouTube page so that you can start to reprogram our brains about what is available as you continue to grow. So thank you so much for being here and sharing so transparently and thoroughly. This has really been helpful.
Yeah, thank you, Kanisha. I'm grateful for the opportunity. I appreciate it.